The latest sign of thawing of the credit markets. Leveraged loans, the pariah of 2008, have bounced back in 2009. Our Margaret Popper is on the story. Margaret, this could be good news for private equity firms, right?
That's absolutely right, Allison. We've seen some refinancings recently, and that's really the sign of what Allison was talking about, the thawing of the credit markets. Hospital operator HCA Inc. was able to issue $1.25 billion of new debt last week to repay a portion of its $33 billion of outstanding debt. Ford came to market with $1.75 billion of new debt, and chemical company Polymer Group was able to extend parts of its $455 million credit facility. As a group, leveraged loans have bounced back to trade above 83 cents on the dollar. That's after hitting a December low under 60 cents. But these loans are not without risk. Default rates are around 6% according to Standard & Poor's, and that's double the historic average. And loan issuance is way off its peak. In the first half of this year, banks arranged $41 billion in leveraged loans in the U.S., down from $187 billion in the first 6 months of 2008 and $549 billion in the first half of 2007. We're not seeing a flood of new deals yet, but people I'm talking to say that could come next.
Well, Margaret, why is loan volume still so low?
Well, the banks got burned on this stuff, Allison. You have to remember that basically leverage loans were sort of the subprime of corporate debt for a while, especially late in 2007, early 2008, when there were these things called PIK toggle notes. And what that was the ability to defer your interest and add it to principal. Sounds familiar, of course. Sounds like a subprime mortgage. So these deals started to go to make people worry, although, again, the default rate isn't that high considering how much risk there was out there. But you saw the banks dumping these things. Citi wrote down about $7 billion over the past year, and you've seen more sales of them from banks to get them off their books.
Okay, Margaret, thanks for that.